the financial crisis, late 2008, early 2009, there was a lot of stuff that was crashing and burning. One particular industry that got really, really almost destroyed, hammered really badly, was the commodities industry. So almost all commodity prices collapsed to levels, unprecedented levels, because demand went down so much. So there was a blue chip Canadian miner in Vancouver called Tech. They had a very dominant footprint in metallurgical coal. And metallurgical coal is used to make iron and steel. It's kind of like an oligopoly. There are just a few places in the world where you can get large amounts of metallurgical coal. And actually, once you have a steel plant, the chemistry of the particular met coal that you use becomes very specific. So you can't just suddenly switch from one mine to another, the chemistry matters. And so which means that you get into these long-term contracts with these iron and steel plants. So Tech in 2008, they had done a very large acquisition of one of their met coal competitors. And what they had done when they did the deal was they financed it quickly with a 1-year bridge loan. And their plan was that within the year, they would issue long-term debt, 10, 15-year, 20-year bonds, and then straighten out the balance sheet and go about their business. And what happened is they closed the deal with that 1-year bridge loan, and then commodity prices tanked. And the financial markets, for the most part, shut down. So they had no ability to refinance. And it wasn't even clear how they could service the debt because they had taken on so much leverage with some assumptions on what the price and such would be. So the stock, I think, went from $45 to $4 in just a few days. And I looked at it when it was at $4. In fact, commodity prices, the stock price of commodities had just collapsed, and there were so many bargains. But I felt like the banks who had this debt would not want to take over a bunch of metallurgical coal mines because banks are not in the business of running mines. What they would probably do with a company like Tech is they would extract a pound of flesh and extend that loan out a little bit, just because it just made more sense to do that rather than trying to turn the screws on something and then all the company would say, well, here's the keys to the mine, good luck. And they don't want that. They want the loan to be kind of, current and ongoing. And I also felt like they had so many other assets that they could try to sell and do different things, forward sell some production, do different things where they could get out of the jam. So I didn't really see a downside where they would go bankrupt or something. I think that they would be able to kind of work it out. And so we actually invested a good amount in early 2009 in Tech. And within a year, it was back at 45. So they had, kind of exactly what I had forecasted. The banks gave them some breathing room, extracted higher interest rates and all of that. And then they were able to sell some assets, and then they were able to forward sell some sales. And the mix of all that, they got out of the jam, and eventually they were able to refinance the whole thing. So it can create opportunities for an investor. But I think if you're an operator, not going down the leverage path is a really good idea.